Across global trading floors, digital tickers began tracking a sharp downward movement that hit nearly every major index simultaneously. South Korea felt the immediate impact, with the Kospi index dropping over 8%. The volatility reached a point where officials took the rare step of halting all trading for 20 minutes to prevent a complete loss of liquidity. That same pressure moved into Japan, where the Nikkei index saw a 5% drop within a single trading session. While the halt in trading occurred in Asia, the downward momentum actually began during the previous night's session in the United States. Apple, the world's most valuable technology company, saw its market value drop by $250 billion in a matter of hours. This sharp reversal follows months where any stock tied to semiconductors or artificial intelligence seemed to operate outside of normal market cycles, consistently hitting new highs. Understanding why these gains suddenly reversed requires looking at a specific shift in the hardware supply chain and seeing how that shift is now moving toward the Indian IT sector. The shift started with a pricing update. Apple announced it would be increasing the retail cost of its iPad and MacBook lines. This increase is a direct response to the rising physical costs of the AI infrastructure. The specialized memory and storage chips required to power these devices have become significantly more expensive to source. This announcement signaled to investors that even a company with Apple's capital reserves can no longer fully absorb the rising costs of AI hardware. This chart highlights the growing gap between the capital required to build AI systems and the current projections for consumer revenue. For many investors, this data point broke the assumption that AI software growth would easily outpace the cost of the hardware needed to run it. The software side of the industry has finally encountered the hard limitations and the high prices of the physical supply chain. The realization of these rising costs led to immediate sell-offs, a move further intensified by investors closing out their positions for the end of the financial quarter. Market uncertainty increased further as reports surfaced that OpenAI might delay its public listing, leading to more questions about when these massive AI investments will actually generate returns. These concerns moved back to the manufacturing centers in Asia, where the companies responsible for building these chips are concentrated. South Korea's market is particularly sensitive to these shifts because its main index is heavily weighted towards semiconductor giants. SK Hynix, a major supplier of high-bandwidth memory, became a central point of the sell-off as traders reconsidered the sector's long-term profit margins. The volatility in these manufacturing hubs shows how closely the entire global tech market is linked to the cost and availability of physical hardware. This linkage extends to India as well. While India isn't a primary hardware manufacturer, its software sector is deeply connected to the budgets of global tech firms. That connection is managed by foreign institutional investors, or FIIs, who facilitate the flow of capital across international borders. During global tech volatility, FIIs move capital out of emerging markets into lower-risk assets. This chart tracks how that withdrawal directly affects secondary markets, including IT services and software sectors that rely on stable tech spending. This suggests a hardware supply chain crisis can create a direct liquidity challenge for local software hubs, even if they aren't building the chips themselves. In India, the Nifty IT index has already reflected this global risk aversion, dropping by 0.86%. This market pressure is currently affecting the country's largest service providers, including TCS, Infosys, Wipro, and HCL Tech. For retail investors, it is important to note that this correction is concentrated in the technology sector and is not currently showing signs of a broader, multi-sector economic recession. Instead, we are now seeing a shift away from rewarding companies based purely on their association with AI. The market is beginning to prioritize companies that can prove actual revenue and sustainable margins over those relying on digital hype. With chip costs continuing to rise, retail traders and IT professionals should expect the current level of volatility in the tech sector to persist in the coming weeks.